Chapter 4: Market Structure. A complete breakdown. Market structure is the foundation of price action trading. All price movement can be reduced to three stages: bullish expansion, consolidation, and bearish expansion. A bullish expansion happens when price rises, making higher highs and higher lows. A bearish expansion does the opposite, lower highs and lower lows. And consolidation is that sideways pause between them, when buyers and sellers fight for control. Recognizing which stage the market is in instantly simplifies any chart. For example, if price rallies from 100 to 120, pulls back to 110, then rises again to 130, that's a bullish structure. If price falls from 120 to 100, corrects to 110, then drops to 90, that's bearish. Within these moves, we separate impulses and corrections. Impulses are strong directional pushes. Corrections are smaller pullbacks. Knowing which one you're in prevents emotional entries. We also distinguish internal and external structure. External structure is the big picture, the higher time frame, like daily or 4-hour. Internal structure is what happens inside it, the 1-hour or 15-minute swings. Sometimes internal structure appears bearish even when the higher trend is bullish. The skilled trader aligns them, buying internal pullbacks that fit the external bullish trend. Liquidity and manipulation weave through all of this. Markets often sweep liquidity above equal highs or below equal lows before continuing. In an uptrend, price might run above a previous high to trigger buy stops, then retrace, then continue upward. Spotting these liquidity grabs helps you avoid false breakouts. When trends change, you'll see either a break of structure, BOS, or a shift in market structure, SMS. A BOS signals continuation, taking out a swing high in a bullish context or a swing low in bearish. An SMS signals a potential reversal, a broken swing low in a bullish market, or vice versa. Distinguishing between BOS and SMS is key to reading direction. During consolidation, price ranges between support and resistance. These are the zones where institutions accumulate or distribute positions. Patience here is vital. Wait for the clear break and retest before acting. Finally, multi-timeframe analysis ties everything together. You might identify a bullish trend on the 4-hour chart, wait for an internal bearish pullback on the 15-minute, and then enter long when that smaller structure shifts back bullish. That's precision entry with the trend at minimal risk. Chapter 5: Liquidity. The real driver of price. Liquidity is the heartbeat of the market, and yet the most misunderstood. Most traders obsess over structure, supply and demand, Fibonacci, or support and resistance. But none of these outweigh liquidity. On daily time frames, large movements may reflect fundamentals, interest rates, inflation, or geopolitics. But intraday, between London and New York, liquidity drives everything. Here, inducement becomes the key, the hidden engine behind each move. It's simply manipulation or run on liquidity. Inducements appear everywhere, around support and resistance, trend lines, breakouts, and patterns like head and shoulders. Every type of trader gets induced and often taken out. Inducements can be major, medium, or minor. Combine them with confirmations, and you start understanding the true language of price. Waqar has proven this publicly. For over 7 months, he shared trades live, complete with entries, stop-loss, break-even, and take-profit rules. 60 trades in total, verified through brokers, MyFXbook, and journals, producing over 55% profit. All of them built on inducements. Every profitable move begins with a run of liquidity. If you master inducements, double-digit monthly returns become realistic. Because inducements appear every single day. Even so-called smart money traders get trapped, equal highs, equal lows, supply-demand zones, or fair value gaps. These patterns often fail unless you place them in liquidity context. Here's the mechanism. Asia to London builds higher highs and higher lows, inviting buyers. Structure traders expect continuation. But the market shifts bearish, fails demand zones, and takes them out. Why? Because context pattern. Liquidity defines context. If you can identify the inducement of the day, you can trade away from it, and that's how you profit while others get trapped. Once inducement forms, most conventional entries against it, supply-demand, smart money, Fibonacci, are designed to fail. The market creates false reactions to bait traders in, then runs their stops. But if you're aligned with inducement, you trade with price, not against it. The model is simple. Identify a market structure shift, bullish turning bearish, or vice versa. Notice how the old support becomes resistance. Traders enter, placing stops above. Breakout traders also queue buy stops there. Liquidity now exists on both sides. The market induces them, traps both sellers and buyers, and then delivers a powerful move away. That single sequence can yield 1 to 3 risk to reward instantly. To make it reliable, apply context. Time of day, London or New York windows. Higher time frame alignment. Lower time frame confirmation. When all three align, trades are fast and clean, hitting targets in minutes, not days. These aren't slow swing positions, they're precise intraday plays. Average stop losses, 3 to 5 pips. Potential reward, up to 1 to 10 in a single session. Because inducements fuel the next move, even if it's small, the liquidity taken is enough to generate profit. Stack more filters, session timing, refined poise, break-even rules, and take profit management, and you can raise win rates from 60 to 80%. This system is mechanical, rule-based, and built on how the market truly operates. Liquidity first, everything else second. After nearly a decade of testing every course and method, Waqar refined these principles through live data and experience. That's why his results have been proven publicly, consistently. He doesn't sell courses. He mentors a handful of traders through a strict application and interview process. Because true mastery takes accountability, guidance, and repetition. His mission is simple. After 6 months of disciplined learning, his students should be funded and consistently profitable. Conclusion. You've now heard the distilled essence of Waqar's teachings, the inner mechanics of structure, liquidity, inducement, and timing. The market is not random. It's designed to attract, trap, and reward, depending on whether you understand its intentions. Trade with liquidity, not against it. Observe inducements. Wait for confirmation. And let the structure reveal its story, day after day. That's how you evolve from chasing setups to mastering the language of price.